Good evening and thanks so much for tuning in. This is The Money Show on ET Now and my name is Alex Matthew. If you have watched this show over the course of the last several months and years, you'll know that this show deals with money. And it deals with how you can earn more of it, how you can invest it wisely, and also how to spend so that you get the best bang for your buck. On today's program, we'll be dealing with how to analyze the performance of mutual funds. Now, in the recent past, we've discussed alpha and beta, but we'll also be discussing standard deviation, Sharpe ratio, and the Sortino ratio, what all of these mean. We'll make sure that it's not too complicated for you to understand. Then we will speak about the latest update from Knight Frank on the real estate market in various pockets of the country, their outlook for 2022, and what that means for the residential space in particular. And finally, we'll take you through a conversation that we had in the recent past on life insurance and what you need to bear in mind when you go out shopping for a cover. Let's start with the first conversation, and in fact, let me introduce my guest for today. We've got Mohit Gang, who is the co-founder and chief executive officer of Moneyfront. Thank you so much, Mohit, for taking the time. As I mentioned, in the recent past, we have covered alpha and beta as concepts. So let's focus on the other three metrics. But first, just to identify and to understand why it is important to talk about this, is it true that most people look at past returns as a barometer, even in conversations that you have? And why is that not a right approach to take?
Sure. Hi, Alex. Pleasure to be on your show. Look, so I think you are bang on the point when you mentioned that most of the investors today just go ahead, sort the last 1 year or last 3 year returns, identify the top schemes which have delivered the most returns, and then typically will go ahead and invest in it without looking at the objective of the scheme, the size, the AUM, the fund manager, the strategy, and most importantly, the risk involved in investing in that particular scheme. So I think that's in fact the most wrong way of selecting a scheme. Once you select or identify a scheme, you have to weigh the two sides of the coin equally, which is risk and return. What people typically do is just weigh in at the risk, the return part of it, and completely ignore the risk part of it. That is where these ratios come in very, very handy. How to identify the risk involved in the scheme and how to select the less risky schemes delivering the most amount of returns.
Okay, fantastic. So let's first clarify that we are speaking about equity mutual funds, and these things you don't necessarily need to calculate them. Mohit, there are services that give you these ratios. We're just going to help people identify how to make sense of these ratios. So if they see a Sharpe ratio, for example, for a particular mutual fund scheme, they'll know what it means. But let's start with standard deviation. I'm sure a lot of people in statistics class or in mathematics class have actually dealt with this, but how do you understand it in terms of how an equity mutual fund scheme is performing?
Absolutely, Alex. I think most of these ratios are available in fund fact sheets, multiple other websites. So investors really don't have to go ahead computing these. It's just about the interpretation of the number which comes up on the screen in front of you. So let's talk about standard deviation. Now, very simply put, standard deviation is a measure of volatility of the scheme. So when I say that the average return of a particular scheme has been, let's say 10%, and the standard deviation number shows us around, let's say 20%, which means that the scheme returns could be volatile from -20 to +20% of the average returns which the scheme has been generating, which again, to numerically interpret this thing, which means that the scheme returns can vary from 8% to 12%. So that's standard deviation. Now it looks very simple, but when you really expand the term and say that what is two standard deviation returns for the scheme, then the return becomes -4 to +4, which means 6% to 14% if the average return is 10. 95% of the times, the returns of the scheme will fall between the range of two standard deviation, which means when you are investing in a scheme and you see the standard deviation number, you can very well interpret and say that the historical trend is that 95% of the times the return from this scheme will vary from two standard deviation minus to two standard deviations plus of the average returns. And that's where the standard deviation number becomes very, very handy. And the most important part here is you have to identify schemes in the same category amongst the same peer group which have lower standard deviation, which means the volatility is higher and the predictability of the returns is higher. Hence, right? So if the schemes, let's say large cap category, you find a scheme with 20% standard deviation and one with 30% standard deviation, the one with 20, if all the other factors remaining same, the one with 20 is a better scheme to invest with because it has lesser volatility. The returns will deviate lesser from the average returns which have been shown historically to you. So that's how you interpret standard deviation.
Okay, and you've got a few, in fact, you identified a few data points. You've taken down the standard deviation for a few schemes. Why don't we illustrate this just by looking at some of those points? And I believe that you have updated them as to last week's data, right? So how does one understand standard deviation based on the readings of the schemes that you've looked at?
So look again, Alex, as I said, you can't standalone identify a good scheme by just one measure. You'll have to combine it with multiple other factors, and obviously you'll have to keep it along with the returns also. But let's say in the large cap category, we have three names out here. We have a ABSL Frontline, we have Access Blue Chip, and then we have an ICICI Nifty Index Fund. Now, index funds typically will always give you the most average benchmark ratios across all the mathematical ratios. So that should be kept outside the consideration zone. We have just kept it for reference point here. But in this case, let's the index volatility or the index fund volatility is 21%. And both the large cap funds exhibit lesser volatility than the index itself, which means they are better managed on the volatility side than the index has been, than what the index has been. Amongst them also, ABSL Frontline has a lower standard deviation than Access Blue Chip, so which means it is less volatile. However, again, as I said, the standard deviation alone is not a factor, and you'll have to look at other factors like alpha, beta, which we'll talk about at the later end of the show. If you see the smaller cap scheme out here, SBI small cap, it has a volatility of 24%, which by itself proves that small cap funds or small cap as a category will always have higher volatility than the large cap as a category, right? Hybrid funds, because they have debt in your portfolio, they have lesser volatility, and hence the volatility out here is only 18%. So if an investor is conservative, he wants a scheme which is not very volatile, which doesn't show too many variances in the returns, then one can actually go by looking at the standard deviation number and selecting a scheme which has a lower standard deviation number. So that's how you go about interpreting the numbers.
Understood. So like you're saying, it has to be various ratios seen in conjunction. So let's go to the second one. Let's go to the Sharpe ratio. What is it all about, and what does it help you understand?
So look, I will try and make it a little simple out here. I'll continue from the previous example which I took. Let's say the average return of a scheme is 10%, right? Now, and the standard deviation is 20%, basically. So the Sharpe ratio, what it does is it sees your return over the benchmark return adjusted by the risk factor. In the same example, let's say my benchmark return or the return expectation which I have from the scheme is 8%, because 8% is what a normal FD will give, or a normal risk-free rate in the economy is considered to be, though FDs are now running at only 5 to 6 odd percent. But let's assume 8% is my expectation. The average return of the scheme is 10. So 10 minus 8, which is 2%, divided by the standard deviation number, which was 20%. So 2 upon 20 basically is 0.1. So this is the Sharpe ratio of the scheme, 0.1. Now, if let's assume this average return of the scheme instead of 10 was 15, then you would have had a number of 15 minus 8, which is 7 divided by 20. And hence the Sharpe ratio would have been 0.35, which means the return generated by the scheme per unit of risk. So higher the number, better the scheme is. What it actually tells an investor is that how good a fund manager is in managing the risk and delivering higher return with the same amount of risk, right? So when you divide the return of a scheme by the standard deviation, you get the Sharpe number. Higher the Sharpe number, better it is. A number greater than 0.5 on the Sharpe ratio front is very difficult to find. If you find a scheme which is consistently giving you over 0.5 Sharpe ratio, then it's a fantastic scheme, though it's very difficult, as I said. But any positive number you find on the Sharpe ratio, it's a good reading, and you can very well be convinced that the fund manager is doing a good job of managing risks in the scheme per se. So that's how you interpret Sharpe.
Fantastic. And consistency, I would think, is the key here. We'll go into a few examples, but like you mentioned, I think it's a good idea to look at all of these things in conjunction. And so we will do that a little later. There is also the Sortino ratio.
Yes.
What's this about? If you're talking about the Sharpe ratio, which helped you understand the risk-adjusted returns of a scheme, what does the Sortino ratio tell you?
Now, Sortino and Sharpe are like brother sisters, basically. In Sharpe, we took standard deviation as the denominator while computing the risk-adjusted returns. And when we take standard deviation, it means deviation, positive deviation from the average return and negative deviation both, right? So it will measure, even if the scheme is doing much more or delivering more returns than the average returns, then also it gets adjusted in the standard deviation number. And if it is delivering lesser returns than the average returns, then also it gets adjusted in the standard deviation or the volatility of the scheme. But there were critiques who said that why should we consider the higher returns or returns which are above the average returns? They should be eliminated, and only the downside returns or the negative returns should be considered. And one should analyze the performance of a fund manager considering the fact that how well has he managed downside risk in a scheme. Upside, it's not risk at all. Upside, it's a bounty to investors. If they're getting more returns than the average returns, then it's great. Ignore that. So what Sortino actually does is it eliminates the upside volatility. It just takes the downside volatility or the downside standard deviation into consideration. And then it computes the sharpness of the scheme basis the returns generated per unit of downside risk. So risk adjusted return, but adjusted only for downside risk is Sharpe ratio, Sortino ratio. It is one step ahead of Sharpe. Again, a positive reading here means that the scheme has been very well managed. Very difficult to find schemes above 0.5 again on this parameter, but if you find one, it's a great scheme. And again, as you said, consistency is of key importance. So you figure out schemes which have been consistently positive on Sharpe and Sortino, and that's where a true test of a fund manager lies, that he's actually delivering more returns than what you expected and delivering per unit of risk, he's delivering additional returns to you. So that's how you interpret these ratios.
Let's talk about some of the examples that you pointed out for the Sortino ratio. And here, if I'm not mistaken, is this essentially protection of capital and the ability to limit the loss of capital in a scenario where there is a broad-based loss of capital? Is that the way to understand it?
More likely so, Alex. Typically what it is saying is that in markets which are going down, in negative markets or in markets which are seeing sharp correction, how well is your fund manager managing your returns? Is he still managing it very nicely and trying and delivering you handsome positive returns in a falling market, or trying and cushioning your negative loss in a much more or in a better way than what other guys are doing? So that's what it typically tells you. Now, if you look at some numbers, let's say an Axis blue chip, the Sortino is much higher than ABSL frontline, basically, which typically tells that the fund manager actually has been doing a good job in falling markets, or in markets which are going negative. The return generated by Axis is better than ABSL frontline. So this is just interpretation through one ratio. Again, as I told you, you can't judge a full movie by just one scene or something. You will have to put all the ratios together. But yeah, it gives you a good interpretation of how things could be. Similarly, in case of, let's say, an Mirai emerging blue chip, or let's say an SBI small cap, the ratio is much above 1, which actually shows that even in falling markets, these schemes have been quite good in terms of managing their returns and managing the downside risk of an investor. So that's how you interpret it.
Mohit, let's very quickly run through alpha and beta and how they're also important, just so that those viewers who have not heard it on this channel can hear it now.
Sure. Sure, Alex. I think it's a very often spoken term, which is alpha. Very simply put, alpha is something which is over and above your expectation. So when you go to a restaurant for having dinner, you're expecting something beyond your normal dinner, right? You can have a normal dinner at your home, but when you go to a restaurant or when you go to a professional fund manager alike, you expect him to deliver something over and above the benchmark, which means alpha tells you how well a fund manager has managed your scheme. Is he just delivering benchmark returns? So let's say if the benchmark is Nifty or Sensex, is he just simulating the returns of what Nifty or Sensex has been doing? Or is he actually delivering over and above? The higher the number, the better a scheme is, which means the fund manager is actually doing a great job of delivering you extra returns. So go with the scheme which gives you a higher alpha in the same peer group or in the same category. So that's how you interpret alpha.
Okay. And what about beta? This is also something that you need to understand, right?
Yeah. And beta, very simply put, is the sensitivity of the fund towards the benchmark, or it's a measure of your systematic risk in the portfolio. Again, to explain it very simply, let's say the beta. I'll just try and give you an example. The beta of an index or an index fund is always one, basically. So you see any index fund, the beta will show as 0.99 or 0.98, which means it is closely resembling the index or the benchmark. So if the beta is zero point 0.9, that means when the benchmark delivers 10% return, the fund will deliver 9%. When the benchmark falls by -10, the fund will only fall by -9, right? If the beta is 1.2, that means it is much more sensitive, or the sensitivity is much higher than the benchmark, which shows that when the benchmark delivers 10% return, the fund will deliver 12%. But when the benchmark falls 10%, the fund is also likely to fall 12. So it is likely to deliver on both sides, upside and downside, extreme results than the benchmark. So beta in effect measures the sensitivity or the direction in which the scheme can actually deviate from the benchmark. So it is again a measure of volatility, but it is more a directional measure. So if I were to just summarize everything, Alex, alpha is excess return generated over the benchmark. Beta is like sensitivity towards the benchmark. Standard deviation is the measure of volatility. And Sharpe and Sortino are measures of risk adjusted volatility. And Sortino is downside risk adjusted returns, basically. So that's how you kind of interpret all the ratios.
So, in the list of funds or mutual fund schemes that you've looked at, which of them, for example, would stand out in terms of the ratios that you've just pointed out?
So look, again, it is not a exhaustive list which we have prepared. We have this was more for a representation purpose, that we selected schemes out of each category and showed to various investors. Now each investors can have a different risk persona, but let's say if you're just taking an example of a large cap category, Access Blue Chip actually demonstrates that they generate higher alpha. The risk adjusted returns, which is by virtue of Sharpe and Sortino, are also much better than other schemes in the category. And the volatility though is a little higher than other schemes, but that's not like out of the line, right? So when you put everything in perspective, you can easily say that it is one of the good picks or amongst the good picks. Again, but as I say, this is not an exhaustive list. This was just for illustrative purposes, to demonstrate how each category and how schemes in each category kind of show these ratios. So that's how. But yeah, again, as I told you, this is how you interpret within a particular category.
Absolutely. And in fact, if our viewers would like to put this lesson into practice, I think it would make a great exercise to put these things in an Excel maybe, or even write them down, and to identify the schemes that make sense for you. Of course, like you said, your risk perception and awareness of risk is also something that plays a part in the selection of the fund that you ultimately choose. Thank you so much for joining in though, Mohit, for taking our viewers through those key parameters that you use to determine the performance, the relative performance of an equity mutual fund scheme. Pleasure speaking with you.
Thank you so much, Alex. Pleasure.
All right, on that note, we are slipping into a short break, but on the other side of this break, we'll be speaking about real estate. So do stay tuned.